by becoming rich.
Take all your money and buy Bitcoin.
I say when we sell.
Wake up every morning and say GM.
GM. GM. Today is Friday, 9th of August. Daily levels. Let's go. So Bitcoin is bouncing up off the lows. Very strong candle yesterday in terms of retracing a lot of the dump we had before the weekend and going into the start of this week. Want to look at it more from a perspective of how markets move and positioning, what happens when it flushes out, and I'll touch on a couple of things here. The first one being volume, right? So there's a lot of talk and I see a lot of questions saying that the volume on the rally is low, right? We had a big crash down, massive volume, big reversal candle here at the lows with a lot of volume, but everything since that has been very low volume, volume divergences here, right? Higher volume, lower volume. You shouldn't apply the logic of needing high volume after you've had a major unwind of positioning. So what happens, and I talked about this a few days ago, what happens when you have a massive leverage liquidation is it resets positioning. So it sends the market to a level that force closes many positions. So whenever people are forced to sell, and this was definitely forced selling, you don't go from 61k to 49k in a matter of hours without forced closure of positions. That takes supply away from the market. So when the market starts to bounce, there are fewer people to sell because they were already forced to sell. So it does not take as much volume to move price up because there is nowhere near as much overhead resistance. That's why price was able to grind up slowly and then accelerate higher, even though the volume may look like it's not crazy high or not super strong or whatever. That is it's a normal key feature of rising markets after flushes. Even on smaller flushes, you can see this is when we took out these lows, right? Back here. Big liquidation down, huge volume, bounces all the way back up and retraces the whole move. Look at this. High volume on the way down, retraces the whole move back to the origin of impulse with almost no volume. The market is able to do that because positioning was reset. So this happens on big liquidations. It happens on, basically at every point. At almost every point where you take out a low and you have some major high volume liquidations, you'll see it rise typically on lower volume. And when you go back even as far as some of the most extreme shakeouts or flushes, like COVID, if you go all the way back, where you have massive volume liquidation, what happens? Very low volume, price just grinds up in this case, price grinds all the way back up to the origin of the breakdowns over the course of a couple of months with very little relative volume, very little. Nowhere near the volume took us down because, again, people are took out. If you had your entire positioning liquidated or you panicked and sold at the bottom of the crypto crash in COVID, you don't have any coins to sell on the way up. So it's just an absence of sell pressure on the way back up. Now, that's why the price action is important. That's why when you see price after COVID rising with low volume, but making higher highs and higher lows, that's a good sign for the market to continue going higher. It moves up, it moves up, it moves up, it moves up. That's a sign of a recovering market. You also have these examples, like in August of 2023, where you have a massive leverage unwind, a massive unwind of positioning, and price doesn't bounce. Right? It goes sideways. And that's a sign that the market is not ready to recover yet. So what is that? What's the difference? The difference is, why did we go down? COVID went down because of external factors, not related to crypto. Obviously, it's related because crypto is a market, and the market got sold. But the fears were not about the fears of crypto failing or crypto being less attractive or anything like that. It was a global, worldwide positioning unwind. And that's why you saw crypto was able to bounce after, because once the fear subsided and once the Fed came out and said we're going to print loads of money, people are like, oh, wait a minute. So crypto's not going to go to zero. In fact, if anything, crypto's going to benefit from this. Whereas in 2023, this massive unwind of positions was all the short-term positioning that had built up since BlackRock applied for ETF and all the build up here, and it flushed back out. And then there was uncertainty. At this point, there was uncertainty around whether there'd be ETFs anyway. People didn't know. The odds were 30, 40%, not 90% like they became later on. And it took a while. There was no reason for crypto to bounce back up because the selling was legitimate. The selling was Bitcoin at that point was too high up here, dropped down to there, and that was the fair value until there was a new catalyst, which was the ETF rumors really heating up to go higher. I'll take another example that's directly crypto related. Two examples. Luna collapse. We had a massive collapse after Luna, and we did not see a big bounce because that was something that genuinely affected crypto and genuinely took crypto to a level where players were washed out. You had many billion-dollar funds, you had lending protocols, you had Celsius, BlockFi, etc. You had Luna collapse and all the selling. You had $20 billion evaporate. Those $20 billion in UST stablecoin that crypto investors were holding, and it just became worthless overnight. So that was a very much a systemic effect into crypto. That was not like, oh, it's FUD or it's fears about Japanese yen carry trade or it's mild recession fears. It's not that. It's genuinely crypto was over leveraged. We flushed that out. It's going to take a long time to recover. That was the first part of that wave. Second part, FTX. When FTX scammed the whole industry, they removed about $10 billion worth of value from the market. People with their funds on FTX, people holding tokens that became worthless like FTT and other, Serum and all these Solana-based coins. And again, that broke down and did not have an immediate bounce because it was a real systemic effect. It took a while. It had to reaccumulate, consolidate before going higher. Compare that to 2023 March. We had a big sell-off about fears of USDC collapsing, fears of the banking system collapsing, so everything gets sold initially. But then those fears, they do not come to pass, right? USDC did not collapse, it repegged. And the Fed came out and said, we're going to print money to support the banking system, which again is good for crypto. That's like a COVID response, and that's why we've reversed. So in COVID, it was obviously a much bigger crash. But the Fed came out and said, we're printing money. In March 2023, there was a smaller crash. The Fed came out and said, we're going to print money if we need to. If the banks need it, we'll print it. Both of those are exactly the kind of positive catalyst that crypto and Bitcoin specifically wants. And that's why you saw immediate reversals and they went higher. Immediate reversal in March, slower reversal in March 2020, but still, Bitcoin recovered and went higher. So what you should ask yourself whenever you have a mass liquidation event and a reset of positioning, like we saw on Monday, you should ask yourself, okay, is this systemic? Is this something that's going to hold Bitcoin down for months? Where we have the typical sideways downwards action that people expect, like a post FTX or post August 2023? Or was this a big fuss over nothing and Bitcoin should not have been affected to the degree it was and we should go up? I think this example is exactly in the middle of both. The Fed are not coming out saying we're going to print infinite money. They will probably cut rates in September, but that was already planned. So I don't see a policy response the same as we had in March 2020 or March 2023. I also do not see a systemic effect like we saw when China banned crypto, which caused Bitcoin to be weak and the bounces to be shallow. And I do not see the same as Luna when, the whole market imploded. I do not see the same as FTX when the whole market imploded again. So we have something different. I don't think it's going to do a full V reversal to new highs very soon, like March. I also don't think that it's going to chop around to the side either, which is probably why we're going to see something in between the two. And then we want to look at it and say, okay, What caused this crash? Leverage was getting wiped, yes. Every time the market goes down and it's over leveraged, leverage gets wiped. Cool, so we've had a reset of positioning, we know that. That's why it's able to bounce with lower volume. Right, we already know that. But in the mind of the market, what were the other external causes? Just like COVID, fears, just like March 2023, banking collapse fears. What were the fears that drove this move? Recession, number one. Not number one, I don't mean number one in terms of impact, it's just one of them. Recession fears and the yen carry trade. Those are absolutely the two primary reasons that the market is applying, okay? You look online, you look at the videos, you look at the fucking breakdowns, you look at the threads. What's people saying? People are saying, there was economic data on Friday, which came out here, that's what this line is. This is the exact price at which that recession data came out, where the jobs market got weaker and the market started to price in the possibility of a recession. And then you had the Japanese yen carry trade, which is here. And if we zoom this out, the Japanese yen carry trade. So you can see this by the US dollar Japanese yen chart. When did it really unwind? Until this second leg, this liquidation leg, this was a pretty normal pullback. You know, you see these pullbacks all the time. It doesn't mean the carry trade's blowing up, right? It doesn't mean the carry trade's blowing up. It's just pullbacks, charts pullback. But after that, whenever it broke from here on the 31st of July, that's when the trade really unwound and unwound and unwound all the way into Monday of this week. So you go back to the 31st of July and say, okay, where were we on the 31st of July? And you drag it over here. That's where Bitcoin was trading before the Japanese yen carry trade started to unwind. And you'll notice that as JPY, USD JPY started to break down, so did BTC. So it was correlated at the time. You can see this very clearly. Obviously, this market is not open 24/7, so there's more price history for Bitcoin. But you can see it over here. Here's the 31st, right? Bitcoin was consolidating. Bitcoin broke to new lows right at the same time that the USD JPY broke to new lows as well. And then they followed each other all the way down until the bottom. So that correlation tells you the Japanese yen carry trade was absolutely a factor in Bitcoin. Now, should that be something that sends Bitcoin to new lows, to 40K, to 30K? No reason to suspect that. No reason to suspect that the Japanese yen carry trade is going to have a continued effect on crypto. Of course, if equity markets and all that keeps unwinding, sure, it can have some weakness. But if it was just that, and if the fears were not real, if they were misplaced, and it's just a normal unwind of a leveraged trade, it's not like systemic going to send the global economy into a crash, then you would say Bitcoin's fair value before that was 66. We could easily go back there. Before the recession fears, Bitcoin's price was 64.5. Again, if recession is not a reality, and the market was a bit afraid about some weak jobs data, but then it turns out it's not actually the case, we could easily just teleport back to 64.5. This is what happens whenever, and if you use it through the lens of volume, and I put a volume profile across all of last week, right? There's where we traded last week. So you can see on this bounce, we come up to the value area low and almost to the point of control. That value area, that is where price was trading. That was fair value last week. There's no reason why we can't be there again this week, based on the theory of whenever an effect happens that does not materialize into something more real or get worse, we can go back to where we were. Now, there's another factor you have to consider. There's other things going on underneath that will have happened. There's probably going to be some crypto funds that blew up. There's going to be some selling from other players that we maybe don't know about yet. And so that's why it does not have to go all the way back there. It can bounce up into this area, which is probably like something that I expect to see roughly would be like something like this, and we probably top out around there as we do go back and retest those areas. But we probably then drop back down and fill in this gap at some point, which I'll explain that in a second. But the idea of returning back to value, this is completely logical. I want you to think about it in terms of auction market theory. What is auction market theory all about? It's about supply and demand. So, if you have, for example, let's use an analogy of cars. Okay, so cars, there is a Toyota is worth 30K. brand new, right? Or second-hand, sorry, I should say used cars. Used cars have more variance in the prices. Used cars. Toyotas are worth 30k, okay? So that means that the public are going to be willing to pay 30k. And this would be like the price, 30k, 30 and a half, 29.5, it doesn't change much. What's going to move it to 34 or move it to 24? It's going to be some changes. It's going to go up to 34 if there's an excess of demand and a lack of supply. So that could be something like the market wanting more, like we saw with COVID. Whenever COVID happened, used car prices shot up because people were basically stuck in their house. They couldn't travel. They couldn't go on holidays. They couldn't fly. They couldn't go out to nice restaurants. They couldn't do the stuff they normally did. So a lot of people were sitting at home with money still coming in because the governments would give them money, or they would keep their job and work from home. And they had excess money, but they couldn't go places. So they wanted to consume other things. A lot of times people bought a new car, or people bought a new TV or a new washing machine, all this stuff that you don't really would need to normally, but you got this excess cash and you can't go on holiday, you can't do this stuff. And at the same time, you had a supply shock from China because China shut down, and China is the world's factory. So there was a big squeeze on new cars because a lot of new cars, the parts are made overseas, they couldn't get into each country, right? New cars production dropped off. People still need to get a car, so the used car market boomed. That was what caused used car prices to rise. What caused them to drop? Same thing, or the opposite happening. Whenever the supply chain eases up, and there is a steady flow back in of the previously scarce parts or whatever it might be, the demand will drop. Obviously, the demand will also just drop naturally. If there's 1 million people and COVID happens, and then, they need to buy a car, and instead of buying a new car, they have to buy a used car, and then 500,000 people buy used cars. There's fewer and fewer people to buy more new used cars. And as price rises and it's at 35k, people say, no, it's not attractive, right? The first wave of people who want to buy, they buy. Then the next wave of people are like, well, I don't need a used car, so I'm not going to buy it. So you just get less demand. And then price would revert back to the mean at that point. It would go back to the 30. And then when you see an excess of supply, this is what happened after COVID, where you see the used car prices really coming down as new cars start to come back online, as the factories reopen and they start to ship stuff worldwide. There's more new cars coming in. So people have an option now of a new car, which they may not have had before. Used cars are less attractive. There's fewer people who want them because they've already bought them. And so we go the other way. And actually used cars become cheaper. Another thing that can do this, which is what I want to talk about here, is you can also have a problem. Imagine that there was a recall. And they said that Toyotas have an engine fault. Right? So Toyotas were 30k, but they announced that there's an engine fault. And the engine fault means that you're going to have to, if your car is affected, you're going to have to pay 10k to fix the engine fault. Well, that immediately means a 30k car is a 30k car, but it might have a 10k premium to fix it. So the market will not want to pay 30 and it will drop to 20. This is just hypothetical. It's not going to be exactly that, but you get the idea. So imagine that happened. And then you're at 20, let's say you're at 20k now because there's a fault. And then they come out and say, oops, false alarm. There actually wasn't a fault. Toyotas are fine. Well, at that point, anyone who's smart is going to be tripping over themselves, running and sprinting to the dealership to buy as many Toyotas for 20k as they can, because they're able to buy it for 20 and sell it back for 30. There is no problem. There's no 10k problem that needs to be fixed. The market will correct itself very quickly and it'll go back to 30. Why does it go back to 30? Because that was value. Before any of the external effects, that's how much a Toyota was worth. Before the COVID squeeze and before the fears about the recalls or broken, faulty cars, that's how much a Toyota was worth, and it returns back to that. That's why price returns back to value. And that's why when you're looking at the volume profile, that's why it trades in here most of the time. If it goes down, it comes back up to value. If it goes up, it comes back down to value, unless there is something that changes the price permanently. Obviously, markets are much more uncertain. There's far more factors affecting them than just that. But if you think about it that way, did all that caused this move down come to pass? Did we get a recession? No, we don't have one yet. Is the Japanese yen carry trade as bad as first feared? Probably not. It'll probably keep unwinding, sure. There's probably some big hedge funds that got wrecked, sure. Should that be a long-term drag on Bitcoin? No. So we can go higher here for sure. The difference of March 2023 and March 2020 is that we don't have the Fed coming out saying we're going to do something new. There's going to be new money printing. If the Fed came out and said, boom, we're cutting rates early and we're going to ease the markets more, that's when you're going to see it break higher. That's where you see a March or a March 23, March 20. So in the absence of that, I think we're doing what we should do, which is revert back to the mean. The lower volume is fine. I've explained this already. Lower volume is fine. Positioning is reset. But what that lower volume means is, what goes up must come down and vice versa. So the fact that it's rising on low volume means that whenever this tops out and whenever we reach resistance and people start to sell, it can very easily drop back down through this inefficient period or this inefficient area here. I see no reason as to why whenever this move is done, Bitcoin can't come down and revisit this previous area of consolidation at least. So I'd be looking at that 55 to 57 area to get revisited later on. Depends how high we go, depends on the pullback and all of that. And I don't think it's going to fall down straight away. This is what people tend to think, is they think it's going to fall right away. It's unlikely. And I'll talk in Trade of the Day about exactly how to trade this on the short term based on the same idea of positioning. And so, now people are thinking, do I need to get back in? People ask me, have you bought your coins back and all this kind of stuff? No. Because for the same reason that when we were going down, it wasn't crashing and going to zero and you don't have to massively panic. If you're going to panic early, right? Sell before, like I did last Friday. Once all this happens, you wait and see. Once it bounces up, doesn't mean we're back. Doesn't mean that we're going to 75. It means we're going back to where we came from. 65, 66, sure. No reason why I couldn't go there. To go beyond that, you need a new catalyst. Some new thing to push the market. I don't see that yet. So I think the most likely is something like this, roughly. Very rough. I mentioned, like I was saying this in the council last night, I think that we can see something like this where there's a continuation of a squeeze, a bit higher, maybe to there, maybe to here, I don't know. And then it falls back and fills in, and we form a proper low again, and we consolidate, and Bitcoin breaks out later on. If this is true, if this is going to happen, Bitcoin will now fall into, it's got back into the range, and it will continue to consolidate in the range until we have a catalyst that breaks us out to the top. And of course, maybe things get worse and we go lower. That's also a possibility. But with the nature of this move so far, it tells me that Bitcoin does want to be inside this range. And although we don't have full confirmations yet, and we have still got some, we haven't reclaimed the value area yet from this move up, all the way over here to the move down, right? We're just right up at that value area. We are inside it, which would mean a move to the other side of value potentially. But of course, price could reject from here and remain bearish. I think it's unlikely. With the nature and the strength of this move, I think Bitcoin is going to go higher in the near term. It's probably going to go into this grind higher and chop until people think, fuck, like I have to buy, and then we pull back. Just a standard pullback because there was low volume on the way up. It can be low volume on the way down, and we can fall back until there's really strong. Until there's an area with a lot of strength, which would be this breakdown candle and the recovery after it. Maybe even something like this, where you come back to that area. That would be like the perfect sort of over touch or whatever, but don't expect that necessarily. I think that if you're looking to fill spot bags, higher time frame positions, all that kind of stuff, it's going to hang around here, which is why I don't think we pull back straight away, because everyone wants to buy the dip now. Everyone wants to get back in, right? So if it did pull back all the way back down really fast, that would probably actually be a sign of weakness that would make me even more hesitant to buy. If it continues to push higher, that's when people think, shit, I've missed the chance. How do I get back in? And they convince themselves to buy at a bad place, and then a few more weeks of pullback or chop happens to bleed them out. This whole path, by the way, like you're talking about 18th of September is when the Fed meeting is next. Like a lot can happen between now and the Fed cutting rates. So hopefully that explains a little bit behind the logic behind these crashes and how they can bounce and the positioning and the way you have to think about what caused us to drop. COVID caused it to drop, but it was not bad for Bitcoin. Once the initial deleveraging happened and the fears subsided, it was actually really bullish for Bitcoin. Infinite money printing, amazing for Bitcoin. March 2023, the fear was about USDC, a stablecoin. Bitcoin doesn't give a shit. Bitcoin's designed that you don't need stable coins. And then it didn't depeg, and Silicon Valley Bank collapsed, but then the Fed said, we're not going to let anything else collapse, we're going to print more money. Bitcoin loves that. Away it goes. Versus Luna, genuinely bad for crypto. FTX, genuinely bad for crypto. China mining ban in May 2021, genuinely bad for crypto. And each of those examples led to either new lows, like Luna, or like FTX and China mining ban, it led to 2 or 3 months of sideways chop at the bottom as the market built a new base. So I don't think we see that 2 or 3 months of chop at the bottom, because this reaction wouldn't have happened if that was going to be the case. Right? Just like you did not see a two-legged bounce from FTX. You saw one reaction bounce, which is just strictly massive liquidation. You get an automatic reaction bounce, but straight back to the lows, right? And in 2021, same thing over here, right? You get your initial flush and your initial fast bounce, but it does not break above any of the previous levels. It does not hold up. It does not consolidate. It just falls back down and goes sideways. So I don't think we're doing that, because we dropped down, we bounced up, we held, we consolidated, and we had a big impulse higher from it, and we broke some structure. We actually reclaimed the breakdown level of Sunday, the breakdown highs. So I don't think we moon. I don't think we go to 75 or even 70 in the short term. I also don't think we nuke. I think this is where Bitcoin starts to consolidate, because it's exactly where it was before all the fears, and that's probably where it should be after the fears. That's where we're at. And that's it, GM. Check out Trade of the Day, though, because I'm going to break down exactly why I think this goes higher and how you can trade it, GM.